Welcome to the Dough Roller Money Podcast. I'm your host, Rob Berger. Today in episode 331, we're continuing a response to a question that was asked in the Dough Roller Facebook group from a member named Joshua. And as you may recall from the last episode, it had to do with retirement investing and whether we should sort of tilt our portfolio towards stocks that pay higher dividends. In the last video, the first of two parts where I respond to his question, I talk about the 4% rule, how it came about, the data that was used to reach the conclusions that William Bengen, the author and a financial advisor that came up with, wrote the paper that became the 4% rule. He actually didn't call it that. And so we went through that in the last episode. Hope that you found that helpful. Today I want to focus in specifically on dividends. Folks have an affinity to dividends that is frankly misplaced. And I want to explain why. And I think that's true even in retirement. Now, I get the appeal to dividends. The idea would be, let's say you own 1,000 shares of a stock or of an index fund, S&P 500 fund, and it pays a dividend. And so you get this money and you look at your account and you still have 1,000 shares. That hasn't changed. And depending on the timing and what's happening in the market, the value of those shares could have actually gone up since the dividend was paid, even the next day, depending on what's going on in the market. So it's kind of like having your cake and eating it too. It's free. That's almost the feeling. And then at the same time, particularly in retirement, there's a real fear about selling stock. If I can live off the dividends, I don't have to worry about running out of money because I'm not going to sell any shares. Or if I can live off predominantly dividends, maybe sell a little bit here and there when I need to, but it'll protect my nest egg. And the short answer is it actually doesn't in any way, shape, or form. It feels like it does, but it doesn't. And I'm going to do my best today to explain why I believe that to be so. So let's first, just to bring everyone up to speed, here's Joshua's question, if you're watching the video of this podcast. But again, he's pointing out that, look, we're in the middle of COVID-19. No one knows what's going to happen. Stocks, of course, are down right now. Frankly, I don't think they're as down as far as I would have thought they would be. But yeah, they're certainly down. Been a hard year. And, we got growing. He didn't mention this in his question, but look, we got government debt going up by what, 4 or 5 trillion? Some ridiculous number this year. And we're not even done yet. And businesses are shut down. Surely, someone has been predicting a bad market for a decade now. Surely now it's going to happen, right? And we're going to have this bad run for some number of years. Wouldn't this be a great time to tilt your portfolio towards dividend paying, in this case, mutual funds or ETFs? So that was his question. Let's bring back up the funds that he was mentioning. Here's the first one, or the only one that he mentioned, the Vanguard High Dividend Yield. You recall from the last episode, I compared it to the Vanguard 500 Index Admiral Fund, and recall that S&P 500 has outperformed the dividend paying, the Vanguard High Dividend Yield Fund over the last 10 years. Let's just go back and make sure we can remember that. I'm going to split this out onto 2 screens on my computer so you can see both of them. If we look at the last 10 years, the High Dividend Yield Fund has returned 10.27%. And the S&P fund 11.57%. So one question to ask is, why is that? I mean, if dividends are so good, why would one that pays more, a higher yield actually not perform as well? And I think the answer in part is that funds that pay high dividends tend to fall into the category of value funds. And so keep in mind, we've got value. They divide stocks. They kind of slice and dice stocks in a lot of different ways. And the same is true with stock mutual funds. So you can think about a stock being a U.S. company or a foreign company. Same thing with a fund, an ETF or mutual fund is investing in U.S. companies or foreign companies, big companies or small companies. Well, another way they slice and dice it is value versus growth. And the idea is value would be a company that is trading at a price that is, think of it as something that's on sale. It's trading what might seem to be below its intrinsic value. And these are often boring companies, car manufacturers, except for Tesla. The sort of staple companies, utilities, kind of old, stodgy companies. And then there are those companies that many believe will really grow their earnings significantly, well above average over the coming years. And so as a result, they tend to trade at higher PEs. And they're called growth companies. And a good example would be Amazon or Google. I think Apple was a value company for a long time. I think it's kind of in the middle. But in any event, when I was thinking about this fund that Joshua mentioned, the high dividend yield fund, I thought, there's no question this has got to be a value fund. And sure enough, it is. And how do I figure that out, or how do you figure that out for some investment you're considering? Well, I'm in Morningstar. I'm looking at the fund. I go over to Portfolio, and it's going to bring up this grid that Morningstar has kind of become famous for, if you will. And for stocks, you can see they're kind of complicated. It used to be like a tic-tac-toe grid, 9 boxes. But then they have these gray boxes on the outside. I don't know. It's confusing. But the 9 boxes are where you should focus. And this fund is the blue dot, and it's in the top left. Top meaning it invests in large companies. And the left is value. And you can actually see value here. They abbreviate it VAL. So yeah, this is a large cap, value-focused company. Now, if we go over to the S&P 500 index, it invests in sort of everything. So it should be a blend. It should be in the middle. It'll have some value, some growth. And sure enough, if we go to the portfolio, right in the middle. And you can actually see this in the numbers. So for example, in the high dividend fund, the price to earnings is 13.10. And the price to earnings for the S&P is 16.8. So, and you would expect that for a value fund, the PE is going to generally be lower than a blend fund like the S&P 500. And you can also see it in other metrics like price to book meaning the net worth of a company. Usually people think of net worth as tangible net worth, meaning they don't count intangible assets like goodwill, for example. But in any event, there's different ways to calculate it, I suppose. But however Morningstar calculates it, their price to book is 2. So that means for every $1 in net worth, it trades at $2. All right. Now that may surprise you. You might say, wait a minute, it trades at double the net worth of the collective companies in that fund. Yeah, that's actually pretty common. And in fact, the S&P trades at 2.43 price to book. Again, the dividend yielding company, since it's tilted value, you would expect its price to book to be lower. Now, by the way, we can bump over here. I'm going to open up another Morningstar window real quick and look at, say, Amazon. And it's, let's see here. Bear with me. Its PE is ginormous. Oh yeah, here we go. Its consensus forward PE is 82. So if its earnings stayed the same, it'll take you 82 years to get your money back in earnings. Its price to book is 19, right? Definitely a growth company. Anyway, so I point this out because over the last number of years, growth has generally outperformed value. You see that in Amazon and Google and in the tech companies. They really have sort of been the outperformers. That's not always the case. Sometimes value shines. And in fact, there could be periods of time when this Vanguard high dividend yield fund might outperform the S&P 500 index fund. It hasn't in the last 10 years, again, because I think growth has done so well. And I point that out just to try to gain some understanding as to what's going on with these two funds and the performance and the yields. Now, that still doesn't answer the question, why am I against tilting a portfolio towards dividends? So the first thing I want to say on that is I view dividends, and I mentioned this in the last episode, a lot like required minimum distributions out of a retirement fund. They share a lot in common. Number one, you don't control timing, right? You can't call up the IRS and say, I know I'm supposed to take an RMD, but I'm going to skip it this year. Because if you do, actually, technically you can, but I think it's a 50% tax. Now, of course, in 2020, the CARES Act has alleviated the RMD for 1 year. But putting that aside, you don't normally have any control over timing. And the same is true with the dividend. I can't call up Tim Cook and say, hey, Tim, buddy, listen, I don't really need the dividend this year. Can we skip it? He's probably, not going to take my call. And you don't have control over the amount, right? The RMD is a formula. You can't change it. And you can't call up companies or mutual funds and say, I want to change the amount of the dividend you're paying me. Now, strictly speaking, if enough owners got together of a company, they could maybe vote in a board of directors that would declare dividends to their liking, but as a practical matter, that ain't going to happen. Certainly you and I aren't going to make that happen. So you don't control the timing, you don't control the amount, and when you get it, you get taxed on it. Now, I know inside a retirement account you don't, but if you have taxable funds, you're going to get taxed on the dividends. And of course, if you're going to live off of them from your retirement fund, you're going to pull them out. Unless it's a Roth, everything gets taxed. But certainly in a taxable account, you're going to get taxed. And so there's a lot of similarities between dividends and RMDs. Now, of course, that doesn't necessarily make dividends a bad thing or a portfolio that's tilted towards it. But I'm not done. Now, the next thing I want to mention is that a focus on dividends neglects other aspects of investment, and particularly share buybacks. And I found a presentation that I think is quite good, and I'm showing it on the screen now. It's JP Morgan, and it's called Guide to the Markets. They do one every year, and it's a bunch of charts, and they're actually quite good. I highly recommend this. And the chart I want to show now is called, it's actually on page 8 of this PowerPoint, and it's total shareholder yield by sector. And what's interesting is they don't just stick with dividend yield. They also factor in buyback yield, because when a company buys back its shares, assuming it's buying them back below intrinsic value, it has just as good, I think an even better impact on investors because you don't get taxed. And so when you look at this chart, there are some high dividend yield sectors, energy being the largest, but there's a ton of buyback yield depending on the sector. Financials is huge. Their total yield is 7.6%. 5.2% of that is from buybacks, not from dividends. So if you focus too heavily on just the dividend and you lose sight of the buyback yield, which, by the way, I know it's not as tangible. One would say you can't eat your buyback yield. You can take a dividend check and go to the grocery store and buy food, but you can't take your buyback, right? Because you still have to sell a share or some number of shares to generate money, capital to spend in retirement. I got it. I'm going to get there in a minute. But in terms of total return, the buyback yield is critical. And so this chart, I think, does a good job of showing just how important it is, depending, again, on the sector. Now, having said all of that, I think one mistake is that folks tend to think the dividend yield is safe. That, yes, stocks can go down in value, but at least I'll be getting my dividend. And there is some truth to that. And I do take some comfort in the dividends that I get, and it can help us weather the storms to a point. But we have to be very careful that we don't overdo that. For example, I own shares of Citibank and US Bank. They both pay pretty significant dividend yields. I would not at all be surprised if those dividends go away, at least for a time. JP Morgan, Diamond had and I haven't finished reading it, but it's like a 25-page shareholder letter this year. And he basically intimated, yeah, Chase could be eliminating the dividend, not so much because they have to, and regulators have not stepped in yet, which they could. Certainly, they couldn't issue dividends back in 08, 09. But because of the crisis and preserving cash and just being safe, Shell just announced, I think the first time since World War II, they stopped their dividend. Of course, the energy sector has been clobbered. But the point is, dividends aren't guaranteed, and they do come and go. In the 08, 09 crisis, banks stopped paying dividends, car makers stopped paying dividends, and I was looking up some data on that. This is a chart of the S&P 500 dividend yield by month. And I'm going to go all the way back to October of 2007. That's kind of when the market was at its peak before it started to tumble down. And the yield was 1.88%. Now, as prices start to go down, all other things being equal, the yield goes up, right? Assuming that no one cuts their dividend, no one decreases it, maybe they even increase it a little bit from year to year, then you'll expect the dividend yield to go up, and sure enough, that's what you see. And I fast forwarded to March of '09, which is kind of the bottom of the market, and it was 3.6%. So sure enough, the market went down and the yield went up. That doesn't actually mean you're receiving more dollars in your dividend checks. It's just that in this case, the price went down. So when you calculate the yield, it goes up. But I was curious about that number because I thought, it kind of surprises me. It doesn't surprise me that it went up, but it more or less doubled, and the market more or less got cut in half. But I know that folks were cutting their dividends, companies were. And it occurred to me, yes, right, but even though this was the bottom of the market, it wasn't the end of our pain. And you recall, and let me just flip over to another chart, this is the unemployment numbers. They got ugly, and they got ugly long after '09. Yeah, they were bad in March of '09, 8.7, but then they went into the nines, hit 10% in October, stayed in the nines for, goodness, I'm looking at it now, a couple of years. They didn't get down into the eights, which is still high, until 2011. And so if we go back to our dividend yield, and we look at, again, starting with March of '09, we move forward, it starts to go down. Now, yes, the market's going up a little bit, but remember, it didn't recover till 2013, and we get down to yields under 2%, and that's with the market still relatively low. And that's where you start to see the impact of companies cutting their dividends. Now, the yield obviously didn't go to zero. I think around 1.8, went into the 1.7s. That was the lowest. And then, of course, it eventually started to recover, and now it's about 2.25. But the point is, dividends aren't guaranteed. And in bad markets, your dividend checks will get smaller because companies will stop paying dividends or cut their dividends. Yes, not all companies do that, but they will cut them. Now, having said all of that, I think the big issue, the really big issue with a dividend focus is a misunderstanding. I mentioned earlier, there's this view that dividends are almost free. You don't have to sell any shares. Your share value might even go up the next day, depending on what the market's doing, and you've just pocketed a dividend. It's having your cake and eating it too. And furthermore, if you do have to sell shares, eventually you're going to run out of money, right? If you think about 4%, let's say you sold 4% of your shares every year to generate income, they'd last for 25 years, but then you'd be out. You'd have sold them all, right? Well, not exactly. So let me go to my favorite thing, a spreadsheet, and explain what I've done here. And I'm going to actually delete some numbers to begin with. So what I started with, I assumed we had $1 million portfolio. I just divided it. It doesn't matter what the investment is. We can assume it's an S&P 500 index fund. And I just assumed it has 1 million shares, each worth $1, because it just made the math easier. And I'm going to assume we want, just like our 4% dividend yield, hopefully it goes up each year, the absolute dollar. So I assumed a 4% increase. But I also assumed that the value of this investment is 8% a year. And the idea was, I assumed that this was an investment that never paid a dividend. I guess maybe if it helps, rather than thinking of the S&P 500 index, we could think of Berkshire Hathaway, which doesn't pay a dividend. But whatever, I'm assuming it doesn't pay a dividend. This is sort of the worst case scenario for those dividend investing folks. This would be like the worst kind of investment, right? You're in retirement, you've got investments that don't pay any dividends, so you got to sell shares every year. So in year one, we sell 40,000 shares, and it generates $40,000 because they're $1 a share. And that leaves us with 960,000 shares. But the value of the shares went up at the end of the year from $1 to $1.08. It's going up 8% a year. So even though we have fewer shares at the end of the year, the total value has actually gone up. We started with 1 million. We took out $40,000. The remaining shares, 960,000, went up by up to $1.08, and that left us with just under $1,037,000. Now, we can continue that, and I'm going to put the numbers back in that I just deleted, year after year. So in year two, we're going to, again, we're going to assume, we're trying to kind of mirror this 4% dividend, right? So in year two, we're going to take 4% this time of our new balance of $1,036,000. So we actually get a raise, right? Our $40,000 has become $41,472. And we didn't have to sell as many shares because remember, they're worth more. So we only had to sell 38,400. And that brings our total to 921,600. I know these are a lot of numbers. I'm going to get to the point. But again, the shares went up and our value went up. Now, let's fast forward 35 years. We're still just taking 4% a year. In year 35, that 4% is worth $136,000. To generate that money, we only had to sell just under 10,000 shares. Why? Because 35 years later, assuming an 8% return, the share price is $14.79. Our total share count is down to 239,000, so almost a quarter of where we started, but our value is $3.5 million. So the point is, yes, you're selling shares, but you're also going up in value, and if you're trying to mirror a dividend payout, in this case, we're assuming 4%, and the only reason I assumed that was because that's roughly the yield that the Vanguard High Dividend Yield Fund is paying. 4%, you do just fine. Now, someone could look at this and say, yeah, Rob, but you've assumed an annual return of 8%, but what if there's a bad market? And that's really Joshua's concern. Well, for periods of time, there will always be bad markets, right? Just like in a bad market, your dividend checks are going to go down. They just will. But also, stock values will go down. And so, yeah, we could take this first year and we could say, well, you know what? Instead of assuming a 1.08 return, let's make it a really ugly year. Let's just make it bad right from the get-go, not mess around. We lose half our value. Well, that obviously drops the portfolio significantly. That's not impossible to happen. I guess it went down 50% over 18-month to 2-year period, 08-09. Of course, then afterward, it went up significantly. And we're not assuming that. We're keeping the rest of the years at 8%. And you see your income drops. Of course, we're, again, assuming a 50% drop in the value of the market. If that's going to happen, your dividend checks are going to go down too. Exactly how much, there's really no way to predict that, but they're definitely going to go down. And so, but here, if we then continue down the spreadsheet, you still end up 35 years later with a portfolio of $1.6 million. And at that point, you're taking out yearly income of over $63,000. Now, all of this may be a bit confusing. And so I'm going to point you in the direction of something that I think, if this is at all a concern of yours or anything you're interested in, you absolutely need to read what I'm going to share with you right now. And no, I did not write it. The person who wrote it explains all of this without a spreadsheet. And he does it in a lot more intelligent way, but he's probably a lot smarter than I am. His name is Warren Buffett. And it's his newsletter, or not his newsletter, his shareholder letter that goes out every year. And it's specifically his 2012 shareholder letter. So if you go to Berkshire Hathaway, the website, and I've got it on my screen for those watching the video, and actually if we go back, this is what his homepage looks like. It's pretty bare. I say his, Berkshire Hathaway's. If you go to the 2012 newsletter, and then you scroll down to, I think it's page 19. This is one right out of the archives. 2012 newsletter, yep, page 19. There's a little heading at the top called Dividends. And it's about 2 or 3 pages, maybe just 2.5. What he's addressing here is a call from some shareholders for Berkshire to pay dividends. And folks have pointed out that, you know, Berkshire owns stocks of other companies that pay dividends. And Warren Buffett says he loves the dividends he gets. Why doesn't he pay dividends to the shareholders of Berkshire? And he does a very nice job of explaining that dividends, as compared to just selling, in this case, shares of Berkshire stock, will likely make you worse off. You will be better off selling shares as you need the capital than you would be if dividends were declared and paid out. Part of the reason is taxes. Again, some of your investments, maybe many of them are in retirement accounts, but part of the answer is dividends. The other part of the answer, though, goes back to something that I started with, and there was a reason I looked at this at the beginning of this episode. And that has to do with price to book. Remember, for our high dividend yield, the price to book is 2, and for the S&P 500, the price to book is 2.43. In theory, if you reduce the net value of a company by $1 and the price to book is 2.43, you'll reduce the value by $2.43. Now, and that's exactly what Warren Buffett talks about in the shareholder letter. He actually uses a much lower price to book, 1.25. Now, I don't think his point was necessarily that when a company declares a dividend, and if they're trading at a price to book of 2.43, that for every dollar in dividend, the price immediately drops by $2.43. But over time, what you'll find is that paying out a dividend and decreasing the net worth of a company could have a negative effect by more than just the amount of the dividend. Now, it depends on the company. And there's a lot of assumptions that go into this. But I think his explanation in this letter is worth reading. Now, to be clear, there are some things I like about dividends. I do think emotionally it can help some folks get through difficult markets, even if their dividend checks, I guess they don't issue checks anymore, do they? Showing my age. But even if their dividends go down, it can help, emotionally weather the market. I also like companies where management is sort of compelled to think about the investor and the dividend policy. I always get nervous, even for well-run companies like, say, Google, where they've got all this cash, and it's like, I'm not so sure you're always doing the right thing with that money. And I wonder if you shouldn't be a little more investor-friendly and paying out some dividends. And so in that sense, I very much like dividends. But I think you're taking a big risk if you tilt your portfolio towards higher dividend-paying investments than your standard Vanguard 500 index fund. Now, of all the things that we can do, would this be the worst thing to do? Certainly not. But I think you should do it with eyes wide open. It's absolutely, I think, just mathematically incorrect to believe that all other things being equal, dividends are a better way to fund retirement than selling shares. It's just not true. Now, if you are selling shares, you do have to be concerned with value. So, if we were back in the bottom of 2009, where the PEs were in the single digits and stocks were on sale, you wouldn't want to sell then. And part of the answer to that concern is in retirement, you should have a bucket of at least 5 years of cash and short-term bonds, and maybe even longer than that, so that you can weather the 2009s that you're bound to encounter, like we are now. Well, we haven't encountered something equivalent to that, but we could, right? That's the first thing. The second thing is I'm not advocating a no dividend portfolio. Again, I tend to want to just stick with the market. And right now, if we use the Vanguard 500 index fund as a reasonable representation of the market, you've got a dividend yield of about 2.25. Actually, this shows 2.5. So, I think that can help fund part of retirement, particularly during bad markets. The concern I have about tilting towards value would frankly be the same or a similar concern that I would have of tilting towards growth. Either one can significantly underperform the market over a period of time, as, by the way, has happened over the last decade. As we saw in the mutual funds, the high yield ETF, had a performance of 10.25, I think it was. Yeah, 10.25. And compare that to the S&P 500 of 11.5. Again, that may not seem like a big difference, but it actually is over a 10-year period. So you would have lost out. Now, again, I understand that in hindsight, we can look at that period and see how much it grew, and growth stocks were on fire. Could we be in store for a bad market maybe over the next 10 years where value outperforms? Well, we could. But if you're going to go that route, just do it understanding what you're doing. You're making a prediction about the market. And I just tend to say, you know what, I'm not going to do it. I'll just stick with following the market as a whole for the most part. Certainly 90% of our portfolio does that. And there you go. So I know that I feel like this episode has been somewhat convoluted, if I'm being totally honest with you. But I hope some of this gets through. There's absolutely no advantage to taking out dividends versus selling shares of your company, of your investments. By the way, in the Warren Buffett letter, he actually doesn't discuss it in terms of owning stocks or mutual funds. He discusses it in terms of actually owning your own business with a partner. Think about that. Let's imagine you own a gas station and it made $500,000 in profit. It's sitting there in your business account. Good for you. And you've decided, you've heard, I'm going to live on dividends. So I'm going to take out $100,000 out of my company and live on dividends. Of course, you're going to get taxed. You're not any wealthier. I think we've established that, right? In this case, you've just moved the $100,000 from your business account to your personal account. So you're not any richer because of this transaction. You're going to pay taxes on it. And if your company would sell, or a portion of it would sell at greater than book value, you'd be much better off selling a small slice of your company. You wouldn't have to sell a percent equal to the dividends you just paid, because it's going to sell at greater than book value. Again, in Warren Buffett's letter, he assumes 125% of book value, which is far below, as we saw, the S&P 500 is well above that at about 2.5 book value. So, yeah, a bit convoluted, I feel, but I hope I've gotten the message across. Dividends are fine, but we shouldn't give them more credit than they deserve. Yeah, that's my take. I suspect this is going to spark some questions and debate, so I'm going to direct you to the Dough Roller Facebook group, doughroller.net/Facebook. Love to have you join. Please tell me why I'm wrong. I would love to hear why I'm wrong, or why I've missed something, or maybe just a different perspective. And I think that'd be good for everyone. But again, maybe the most important thing in this episode is that you should read the Berkshire Hathaway letter from 2012, beginning on page 19. Warren Buffett describes it as only Warren Buffett can. Hey, until next time, remember, the best thing money can buy is financial freedom.